The Intelligent Investor is a book written by Benjamin Graham that was published in 1949. It is considered to be one of the most influential books on investing ever written. The book focuses on value investing, a strategy that Graham popularized. The book begins with an introduction to the concept of value investing and how it differs from other forms of investing. He discusses the importance of diversification, patience, and discipline in investing. Graham discusses three types of investors: the defensive, the enterprising, and the speculative. He looks at the differences between these three types and how they should approach investing. Graham explains how the stock market works and how stocks are priced. He also describes the importance of understanding financial statements and the different types of analysis that can be used to evaluate a company. Graham also explores the importance of portfolio management, diversification, and setting long-term investment goals. Here are the top 10 things to know about The Intelligent Investor by Benjamin Graham. Be prudent and patient. He explains that the key to successful investing is to have the discipline to not act on impulse, and to instead take a long-term view. By being patient, investors can take advantage of opportunities that may take some time to unfold. To be prudent, Graham advises investors to make sure they are not taking on too much risk. He recommends diversifying investments across different asset classes and industries, and to not put all of one's eggs in one basket. He also emphasizes the importance of doing extensive research before making any investment decisions. Graham explains that it is essential to have a clear understanding of the potential risks and rewards associated with each investment before committing any capital. By being prudent and patient and following Graham's strategies, an investor can maximize their long-term investment returns while minimizing risk. Invest in what you understand. One of the key principles Graham emphasizes is to invest in what you understand. He explains that when it comes to investing, it is important to ensure that you have a solid understanding of what you are investing in, as well as its potential risks and rewards. Graham recommends that investors take the time to research and understand the underlying fundamentals of the asset they are investing in, such as its historical performance, the management team, and the competitive landscape. Additionally, investors should be aware of the potential risks associated with the asset and be prepared to take corrective action if needed. Graham also explains that it is important to diversify your investments to reduce your overall risk exposure. He recommends that investors spread their investments across multiple asset classes, such as stocks, bonds, and cash, as well as different industries and sectors. This diversification strategy helps to reduce the overall risk of the portfolio, as well as increase the potential returns. Understand your risk tolerance. Graham's advice on understanding risk tolerance is especially relevant in today's uncertain market. According to Graham, investors should be aware of their own risk tolerance and act accordingly. He believed that the amount of risk investors were willing to take should be based on their personal financial situation, their goals, and their objectives. In other words, investors should not take on too much risk if they cannot tolerate or afford to lose money. Graham also argued that investors should be aware of the different types of risk associated with different types of investments. He believed that investors should analyze the risk-to-return profile of an investment before making a decision. Risk-to-return profiles can vary from low-risk to low-return investments to high-risk to high-return investments. Graham stressed that investors should be aware of the risks involved in different types of investments, and should only invest in those investments that fit their risk tolerance and financial goals. By doing so, investors should be able to minimize the possibility of significant losses. Diversify your portfolio. One of the key concepts that Graham emphasizes is the importance of diversification. He explains that diversifying your portfolio is one of the most important steps that an investor can take to reduce risk and increase their chances of success. Graham explains that diversifying your portfolio means that you spread your investments across different types of assets. This allows you to benefit from the strengths of each individual asset and reduces the risk associated with any one asset. He also explains that it is important to diversify across different industries, as this helps to protect against the potential risks of any one industry. In addition, he emphasizes the importance of diversifying across different geographic regions, as this can provide an investor with exposure to different economic conditions. Invest for the long term. Graham argues that, in order to be successful in the stock market, investors must look beyond short-term gains and instead adopt a long-term approach. He suggests that investors should not be too concerned with day-to-day fluctuations in the market, but instead focus on the long-term trends and the underlying value of investments. Furthermore, he believes that market timing is often a fool's game, and that it is better to take a more patient approach, investing in good companies with strong fundamentals and holding those investments for the long run. Graham also urges investors to practice diversification and to avoid putting too much money into one company or sector. He believes that this approach helps to protect investors from significant losses due to volatility or downturns in the market. Furthermore, Graham suggests that investors should be mindful of the risks associated with their investments and should avoid taking on too much risk. Lastly, Graham believes that investors should be patient and disciplined and should not be swayed by market emotions or hype. Invest regularly and systematically. Benjamin Graham stresses the importance of investing regularly and systematically. He argues that regular and systematic investments allow investors to take advantage of market fluctuations, which can result in greater returns. By investing at regular intervals, investors can effectively dollar cost average, meaning that their investments are spread out over time, and thus their average purchase price is lower than if they had invested all at once. This helps reduce the risk of losses and helps to maximize returns. By investing a set amount of money at regular intervals, investors can average out their purchase price and avoid getting caught up in market volatility. This strategy also allows investors to buy more shares when the price is low and fewer shares when the price is high, resulting in a more diversified portfolio. Additionally, because the investment is spread out over time, investors don't have to worry about timing the market. Investing regularly and systematically helps investors to stay focused on the long-term goals of the portfolio and not get caught up in short-term market fluctuations. Seek professional advice when necessary. Seeking professional advice when necessary is a key concept outlined by Graham. He warns against blindly following the advice of others, but does recognize that there are experts in the investment world who can provide valuable insight. Graham believes that when investors are in a situation where they don't have the necessary knowledge or experience, it is wise to seek the assistance of a professional. He recommends consulting with an expert who is knowledgeable and experienced in the particular area of investment that one is considering, and to be sure to ask for references and to thoroughly research any advice received. When seeking professional advice, Graham recommends being aware of the possible conflicts of interest that may exist. Advisors may be incentivized to recommend certain investments that may not be in the best interest of the investor. He says that investors should be aware of the fees they are paying and what they are getting in return. It is important to do the research and ask questions to ensure that the advice is sound and that the advisor is trustworthy. Be prepared to cut losses when necessary. When investing, it is important to remember that not all investments will be successful. It is essential to be prepared to cut losses when necessary. Graham argues that investors should not be too attached to their investments, no matter how much money they have invested. He recommends that investors always have a predetermined exit strategy for when investments start to lose money. Graham explains that investors should never be stubborn when it comes to their investments. He suggests that investors should always be willing to cut their losses short when necessary. This means that if an investment starts to lose money, investors should consider selling it quickly and moving on to other investment opportunities. Graham advocates for investors to be proactive and analytical in their decision-making, rather than letting their emotions guide their investment decisions. Ultimately, Graham believes that being prepared to cut losses when necessary is a critical part of the intelligent investor's toolkit. Don't follow the herd mentality. Graham believed that investors should make their decisions based on careful analysis and sound reasoning, rather than following the crowd. He argued that the herd mentality leads to excessive speculation, often based on emotion, which can lead to bad investments and losses. Graham also warned against investors who try to time the market, arguing that it is almost impossible to predict the future direction of the market. He advocated for a strategy of long-term investing, allowing time for the market to adjust to changing conditions and for the investor to benefit from any potential gains. Graham argued that investors should focus on the fundamentals of a company, such as its financial stability and potential for future growth, rather than the current sentiment of the market. He also suggested that investors spread their capital across a number of different investments, rather than tying their money up in a single venture. By doing this, investors can hedge their bets against any potential downturns in the market or in a particular stock. Have realistic expectations of returns. Graham believes that investors should have realistic expectations of returns, as there is no guarantee that any investment will produce a positive return. He advises investors to look for stocks with a margin of safety, as these are more likely to provide a good return in the long run. He also suggests that investors should set a simple investment objective and stick to it. He encourages investors to think of investments as an ownership stake in a business, rather than just a financial instrument. Graham's advice is timeless, and it is still very relevant today. His principles can help investors make informed decisions and increase their chances of achieving their investment goals. He encourages investors to focus on the long term and to stay away from the get-rich-quick mindset. This means that returns may not be as great as those seen in more aggressive investment strategies. Furthermore, Graham argues that investors should not expect to gain more than the market average from their investments, but should instead focus on minimizing risk and gaining steady returns over time. Take a second to subscribe and like for more Dividend King trading videos.